So, what is ICT's optimal trading zone and optimal trade entry? This is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. Its goal is to identify where a pullback is most likely to end, allowing traders to enter with precision instead of chasing price or reacting late. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range, the optimal trading zone, located between the 61.8% and 78.6% levels, highlights areas where institutional participation is likely to return in the direction of the dominant trend. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-time frame confirmation, this model creates a clear, repeatable framework for high-probability trade entries. Hello, and welcome back to another video here on the ComLucro channel. In this session, we break down ICT's optimal trading zone and optimal trade entry, showing how this framework uses Fibonacci retracement levels and key price swings to anticipate impulsive movements and define realistic targets. We simplify this trading model into 3 clear steps: analysis, execution, and trade management. By the end of this video, you will have a clear understanding of how to trade with structure and confluence, instead of relying on guesswork or becoming the liquidity the market targets. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now let us get started. As we begin our chart analysis, the first step is identifying the main price swings and key structure levels. In other words, using a top-down approach from higher time frames to lower ones allows us to build a complete understanding of market conditions across all levels. When we refer to higher time frame key levels, we're looking at the weekly, daily, and 4-hour charts. Any time frame below 4 hours is considered too short-term for large institutions to properly execute and refine their strategies. When we observe price reacting from a higher time frame resistance level, it is reasonable to assume that institutional participants showed interest in selling at that area. On the other hand, if price moves higher from a support level, it indicates that institutions were likely interested in buying at that point. This approach keeps our focus away from minor intraday price noise. Instead, we concentrate on meaningful moves that suggest strong participation from major market players. These broader trends appear clearly on higher time frames, which we have consistently highlighted as essential for proper analysis. As a result, identifying higher time frame swings and key levels allows us to see the market from a wider perspective and avoid positioning ourselves against dominant flows. From there, we can shift our attention to lower time frames, such as the 1-hour and 30-minute charts, to identify potential trading opportunities. When observing the chart, you will notice that the market consistently moves through impulsive and corrective waves. This fractal behavior exists because of how market participants interact with price. Impulsive waves tend to drive price a greater distance with strong momentum, usually shown by same-colored candles with large bodies. In contrast, corrective phases reflect indecision, appearing as mixed-color candles with smaller bodies and sideways wicks. Being able to identify the end of a pullback and the beginning of the next impulsive move can be extremely profitable, as it allows traders to position themselves early in potential buying or selling opportunities. Now imagine we're in an uptrend and want to buy low and sell high to take advantage of this bullish market. We cannot enter a buy position immediately because price is already extended and may correct at any moment. That is why we wait for a pullback to enter at a more favorable price. The most recent impulsive move started from this point and pushed price higher all the way to this level. The correction will take place within this range, and once enough liquidity is collected and buyers step back in, price is likely to continue pushing higher. If price breaks below this level, it suggests that buyers are no longer in control and the entire uptrend narrative comes into question. This signals strong bearish momentum and a potential reversal, unless the move turns out to be a fake-out designed to collect liquidity below the low before price resumes higher. Now let us return to the correction range. This brings us to an important question. Where should we place our long position and enter the market? If we enter too early, price may continue pulling back deeper, and we could be stopped out even if our overall analysis remains correct. On the other hand, if we wait too long, price may already start moving higher, and we miss the opportunity entirely. So the key to trading in the direction of the dominant trend is identifying the end of the correction, which signals the beginning of the next impulsive move. But how do we identify that moment? This is where Fibonacci retracement levels become essential. We always draw this tool from the start of the impulsive move to its end because it helps define the correction range. Once applied, you will notice several levels appear on the chart. Each of these levels can act as support and potentially cause price to react or reject when reached. However, two specific retracement levels form what ICT defines as the optimal trading zone, or OTZ. These are the 61.8% and the 78.6% levels. There are several reasons why this zone is considered an ideal area for trade entries. Reason number one is a better risk-to-reward ratio. Regardless of where we enter, the first logical target for the trade is the most recent market structure level. When price reaches this level, some traders will take profits or close positions, while others may enter new trades. This behavior can cause a pause, a pullback, or even a reversal. That is why this level serves as our first target. When entering inside the OTZ, the risk to reward becomes more favorable. We always aim for trades with at least a 1 to 2 risk to reward ratio. This is why trading within the optimal trading zone provides a higher risk to reward and results in a more structured and rational trade. Reason number two is a safer entry. The market often looks to remove early buyers and use their positions as liquidity for future moves. That is why waiting for price to reach the optimal trading zone and then searching for long signals can significantly improve our win rate. Of course, every strategy has its drawbacks. With a more conservative approach, we may miss some trades, but missing a trade is always better than taking a loss. Reason number three is a safer stop. The most logical and secure area to place our stop loss is below the most recent swing low. If price breaks below this level, it signals a market structure shift. In that scenario, buyers lose control, and the bullish case becomes invalid. Because of this, bulls will strongly defend this level. As a result, the closer our stop is placed to this swing low, the safer the trade becomes. This is the third reason why entries inside the OTZ are preferred. With all of this in mind, identifying a valid entry trigger within this zone is an effective way to execute a high probability trade. This trigger can come from different price action signals, which we will explain later in the video. Now that we have clearly defined the optimal trading zone, let us move on to ICT's optimal trade entry model. This trading model is built around 3 simple steps: analysis, execution, and trade management. Let us begin with the analysis phase. As mentioned earlier, this strategy is a trend continuation setup, where our goal is to anticipate the end of the pullback or correction and align ourselves with the dominant trend by entering long. In the first step, our goal is to define the market direction and identify the most recent impulsive wave. We only apply this setup when the direction is clearly established. To be considered valid, The latest impulsive move must break the previous market structure. At this point, there is one final condition to check. We must confirm that there is sufficient room for price to move before reaching a higher time frame key level. If price has already mitigated a major supply zone on the higher time frame, we will not enter a buy trade without additional confirmation, because that level has enough influence to potentially reverse the prevailing uptrend. So during the analysis phase, we focus on three things: market direction, the latest impulsive wave, and the available room before price interacts with a higher time frame key level. The next step is trade execution. Here we wait for price to pull back and then apply the Fibonacci retracement tool from the beginning of the impulsive move to its end. We place a buy limit exactly at the midpoint between the 61.8% and 78.6% levels, which is the 70.5% retracement. Our stop loss is placed a few pips below the swing low. The final step is trade management and target selection. We know that when price reaches this higher time frame area, it is likely to act as resistance and push price lower. Because of that, our first target is set just before this level, often near the close of the highest candle. The same logic applies when trading a bearish scenario. So as you can see, this model relies entirely on basic price swings and retracement levels. At this point, some of you may think that trading cannot be this simple and still remain profitable. However, simplicity plays a crucial role in Forex trading. Your trading plan must be clear and straightforward, with mechanical rules that precisely define where your entry, stop loss, and targets are placed. By trading this way, you can rely on your backtesting results with confidence, knowing that emotions are removed from your decision-making process and that your tested results closely reflect real market conditions. Now, this was the core version of the model. We have expanded it further by combining it with multiple smart money concepts, including fair value gaps, market structure shifts, and multi-time frame entries, which we will explain next. We begin with the first type of entry by combining the optimal trade entry model with fair value gaps. Here we have a well-defined uptrend. Our objective is to wait for a pullback and enter a long position at a more favorable price. If price breaks below this level, the entire bullish scenario comes into question, as it signals strong bearish momentum. This defines our correction range, and by applying the retracement tool, we can clearly identify the optimal trading zone. Now, if we look to the left side of the chart, we can see that the most recent impulsive move has formed several fair value gap areas, one of which aligns directly with the optimal trading zone. When price retraces into these zones, they can act as support and potentially drive price higher. A more conservative approach, however, is to wait for price to retrace deeper into the third fair value gap and enter the long position there. This is because price may use the first fair value gap as a liquidity grab, trapping early long positions. In summary, combining the optimal trading zone with fair value gap areas creates strong supply and demand zones and offers a high-quality trading opportunity. So, we move on to the second type of entry by combining the optimal trade entry model with market structure shifts. Here, we had a long-term downtrend until price failed to form a new lower low, signaling a loss of bearish momentum. Shortly after, price broke through the supply level to the upside. This change of character indicates that sellers are no longer in control and suggests a potential bullish reversal. Once price breaks structure above the previous high, it confirms that buyers have taken full control, marking a complete market structure shift from a downtrend into an uptrend. At this point, we can begin looking for long opportunities to benefit from the emerging bull market. This leads to an important question. When should we enter a long position? Even though price has a strong probability of continuing higher entering at a poor level could still result in a stop out. This is where price swings and ICT's optimal trade entry come into play. Our directional bias is bullish, and there is sufficient room for price to move before reaching the next significant higher time frame level, located above. We can now apply the retracement tool to the most recent impulsive move and place a buy limit at the 70.5% retracement level. Our stop loss is set a few pips below the swing low, and our targets are defined according to the trading plan. This is how we combine optimal trade entry with market structure shift concepts to execute a high-quality trade. However, it is crucial to remember that no matter how strong a setup may appear, the market can always behave differently. Risking an excessive amount on a single trade simply because the probability seems high is a poor decision. Trading involves anticipating future price movement, and the future is inherently uncertain. After a 50% loss, a trader must gain 100% on the remaining capital just to break even. In Forex trading, survival always matters more than short-term gains. Now we move on to the third type of entry, using a two-time frame entry approach. In this trading setup, we use two different time frames to execute the trade. Most of our analysis is done on a higher time frame, such as the 1-hour chart, and then we zoom into a lower time frame, like the 15-minute or 5-minute chart, to find confirmation and execute the entry. Let me walk you through the process. On the 30-minute chart, we can clearly identify an uptrend. We apply the retracement tool and define the optimal trading zone. As discussed earlier, once price pulls back into the optimal trading zone, we shift our focus to a lower time frame to look for an entry trigger and execute the long position. However, on the lower time frame, this same pullback may appear as a short-term downtrend. Our objective then is to identify signals that show this lower time frame downtrend is coming to an end, allowing us to enter a long trade in alignment with the dominant bullish direction of the higher time frame. When we observe a clear change of character, it provides a valid signal to consider a long entry. In this example, we know the higher time frame trend remains bullish and price is trading within the optimal demand area. As a result, we have combined multiple price action concepts and confirmations to justify this trade. Combining optimal trade entry with additional price action techniques such as fair value gaps, liquidity concepts, chart patterns, candlestick structures, or any other entry confirmations you use can create a robust and well-structured trading strategy. Before we wrap this up, it is important to understand that ICT's optimal trading zone and optimal trade entry are not isolated concepts. They are part of a broader framework built around liquidity, market structure, and institutional behavior. While this model focuses on price swings, Fibonacci retracements, and precise entry placement, the same logic applies to many high-probability setups based on liquidity manipulation and false moves. One strong example of this logic is the turtle soup strategy. While optimal trade entry defines where we want to enter within a trend, turtle soup focuses on liquidity sweeps and failed breakouts as reversal triggers. Together, these approaches help you better understand traps, reversals, and smart money behavior, forming a more complete and structured view of how the market really moves. Now let us continue and talk about liquidity sweeps, because this is the event that activates the turtle soup setup. Without a sweep, there is no trade. A liquidity sweep happens when large orders enter the market and intentionally trigger clusters of pending buy or sell orders. This creates fast and aggressive price movements that often catch traders off guard. These sweeps always occur at buy-side or sell-side liquidity levels. They are not random. They happen where stops are concentrated and where the market can access liquidity efficiently. A sell-side liquidity sweep occurs when price moves down into a sell-side liquidity level, trades below it, triggers stops from buyers, and then quickly reverses back upward. A buy-side liquidity sweep occurs when price moves up into a buy-side liquidity level, trades above it, triggers stops from sellers, and then quickly reverses back downward. This sharp rejection after the sweep is the first clue that the breakout was not real and that price may be preparing for a move in the opposite direction. Understanding how liquidity sweeps work reinforces everything you learned about the optimal trading zone and optimal trade entry. Both approaches are built on liquidity, inducement, and false continuation. When you study them together, you stop seeing individual setups and start recognizing a complete framework for timing entries with structure, precision, and confidence. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.